I'm Jason Gibb, co-founder of Bread and Jam, and this is Breaking Bread. Every episode, I sit down with the key people in the food world to learn from their experiences.
Today, Nick reveals what a good pitch actually looks like, what makes him actually reply to a cold email, and the one thing in your deck that tells him that you're not ready. This is his story.
So, Nick, you graduated in 2011. What was your plan at this point? Were you thinking about going into the corporate world, or were you attracted by kind of more entrepreneurial things?
Well, good question. I initially thought I was going to go down the corporate route. So everyone I was at university with, to a man, to a woman, has become a banker or a lawyer or something very corporate. And initially that's what I was going to do. And I did my internships in banking and law and all that kind of thing. At the last minute, I decided not to do that. I was slightly at a loss of what to do. So I went and became a headhunter very briefly. So my first job out of university for about 18 months was at an executive search firm. So right. I briefly dabbled in recruitment. I then recruited myself into a new job and left. But I joined my first startup pretty soon after, and it was a very early stage, very kind of scrappy startup. It wasn't food related. It was actually a startup trying to get rid of recruiters, ironically. So it was kind of peer-to-peer referrals, you referring your friends for jobs and kind of cutting recruiters out. So I went and joined that business, and I was employee number 3 there. So
and did that scale fast, that one?
Ish. I mean, we hired a few people. I think it's a good idea. It wasn't necessarily executed as well as it could have been. I think other people have gone on to do the same thing better. But no, that didn't last all that long. And then I joined a place called Founders Forum, who've got First Minute Capital now, the venture capital fund. They've got Founders Factory, the incubator. It's sort of become many things. A few of those hadn't started yet when I joined, but it was kind of a consulting business, a bit of an incubator. And through that, I met the Deliveroo guys. And then I, promptly kind of recruited myself into Deliveroo as a very early employee there.
Yeah. So in about 2016, I think you joined Deliveroo, and there were probably a couple of hundred employees at that stage.
Yeah, I think it was 2015. Yeah, it was, no, much earlier than that. It was double digits, not triple digits. I'm not sure the exact number, but it was really small. I mean, when I first met the guys, it took a while before I joined full time. When I first went in to meet them, they were in the original office, which was next to the BT Tower, no windows, boxes everywhere. And then the team was probably, 10. It was really, really tiny.
Wow.
It took a little bit of time for me to actually fully sign on the dotted line, etc. But yeah, it was definitely, under 50 when I joined. I mean, I think very small.
And what did that teach you about like fast scaling businesses?
Taught me a lot. I mean, Deliveroo in the early days, very, very different proposition to what it is now. I mean, we were, as I say, a tiny team, but also Deliveroo had there was no brand awareness. So my first job there was a kind of very loose role, which was being a city launcher. So they said, right, you're going off to a city on your own to set it all up from scratch. So my first market was Liverpool. So I was sent off, bought a train ticket to Liverpool, off I went, and basically was given a month or 5 weeks to launch Deliveroo Liverpool. So I had to go and sign up every single restaurant one by one. I had to hire all the riders. So, during the day, I'd be knocking on doors of restaurants, trying to get the owners, pitching Deliveroo to them.
And they had no idea who Deliveroo were.
Zero idea. Because at that point, Deliveroo wasn't even across, many parts of London. It was just in sort of South Kent. So, the funny thing was, usually you go in and pitch a product or a service and you say, oh, it works really well for your, this other business. If you go to a Liverpool restaurant owner and say, this works really well in South Kent, they'll tell you to get lost pretty quickly. And so it was definitely a baptism of fire. It was quite funny because there were actually a couple of Liverpudlians in the early team at Deliveroo. And, Will, the founder, and, some of the senior team were American. And then they were like, Nick, you'll be great for Liverpool. And a few of the Liverpudlians raised their eyebrows and were like, really, Nick? I fought through that. I actually really enjoyed my time in Liverpool. And essentially, during the day, pounding the pavements, knocking on doors, pitching to restaurants. And then the evenings, I would be hanging outside Papa John's and Domino's, recruiting the riders. So I would basically, have a piece of paper with some information, grab them and tell them that we'd pay them £1 an hour more or whatever it was. And then, I had a little sort of storage unit in a kind of, in a Liverpool safe store, and I would be spending the afternoons kind of helping riders put boxes on the back of their bikes, measuring them up for their delivery jackets and that kind of thing. But we had all sorts of funny incidents. I mean, some of our riders were doing some things they shouldn't have been, and got attracted the wrong kind of attention. And one day, a whole bunch of their bikes were smashed up, and our lead rider, we only had 5 riders for the whole city. It's so small at that point. Sort of phoned me up and said, we won't be able to do any deliveries today. Someone smashed up all of our bikes because, kind of amusingly, the local drug dealers thought that Deliveroo was a sort of branded drug dealing operation, which would have been quite an amusing concept. But they didn't take kindly to Deliveroo arriving on their patch. Well, they just saw these guys hanging around, not doing a lot because we weren't getting many orders in. Right. So the riders were just sitting there. And anyway, they didn't take kindly to them, or someone said the wrong thing to someone. But it was very much not the, large publicly listed, now privately owned again, but multi-billion pound business. This was real kind of scrappy early days.
Yeah. And so soon after that, I think in 2016, whilst you're still at Deliveroo, you started angel investing. Just before we dive into all of that, can you kind of unpack the jargon a little bit for us? Like what's an angel? What's the difference between an angel, a VC, private equity, family office, that kind of stuff?
Yeah, I mean, angel investor essentially just means that I'm investing in my capacity as an individual. Mm-hmm. Basically, small checks, just my personal money. So family office, is if someone is basically wealthy enough to have people they hire to come in and help them with that investing. So it's still just an individual or a single family investing, but they tend to bring in professionals, and they tend to be writing the bigger checks, and they're doing it through some kind of fund structure.
And is there a typical check size for that?
Yeah, it depends. I mean, some people, there are family offices out there that might be writing kind of 50,000, 100,000, relatively small checks, and there are huge family offices out there who are writing many millions, if not hundreds of millions, and deploying that into either direct deals or backing funds. It just depends on the wealth of the family. But so sometimes the term family office can be used in a slightly grandiose way when essentially it is just an individual.
Got you.
Investing. Yeah.
What I'd love to know is kind of like especially think of it in the journey of a brand, maybe angel, VC, blah blah blah.
Yeah.
So what's the difference between an angel, a VC, private equity, and a family office? Kind of give me the basics.
Well, I think from the perspective of a company raising, your first round of funding is going to be relatively small. You might be raising a few 100,000. And at that point, your most relevant audience is angel investors writing smaller checks, individuals investing in their own personal capacity, and family offices. And there's a whole range of sizes of family offices, but some family offices will invest very early and invest essentially like an individual. VC funds typically come in later. Their check sizes are larger. They're usually looking for a bit more in the way of traction. Right. So some VC funds will invest very early. They'll come in even pre-revenue in some cases, but most often not. And then, I'm massively simplifying here, but a private equity fund would come in further down the line, and private equity funds typically invest in much larger businesses. Often they won't invest in a business until it's profitable, and that'll be for the next stage of growth. So typically, angel investors and family offices for that very first injection of capital. VC funds come later, and private equity, much further down the line.
Right. And family offices are... Explain those to me a little bit more. Yeah,
sure. So a family office is essentially where an individual with a lot of money brings in professional help to help them allocate and invest their money. So essentially it's an individual or an individual family investing, but they happen to have a team of people working on it. So you might well meet the individual with the cash at a later stage, but in the early stages, you might be dealing with a few of their team who will be putting you through your paces in terms of due diligence and kind of interviewing you and that kind of thing.
Right. And now tell me about your kind of your early investments. What were they in? Why did you do it? What attracted you to them?
Yeah, I mean, I think that there's a sort of natural state of being interested in things and wanting to have fingers in many pies, and maybe there's an element of a bit of a gamble and a bit of a punt. But as I say, I went off and sort of got into startup stuff, and so many of my friends had gone down a very corporate route, and that in a way led to it, because a friend of a friend of a friend would have a startup idea, and everyone would say, "Oh, you've got to meet Nick, my one token, startup-y VC friend." So I would go for all sorts of coffees with different people, and they'd pitch me their ideas, and and Deliveroo was very helpful in that Deliveroo had become a bit of a household name and was growing very quickly. So rightly or wrongly, people thought I could answer all their questions and was all knowing. But I would go meet a lot of these people with fun ideas. Obviously a lot weren't for me, and I didn't rate, but I met a few that I thought were really, really interesting. And I started doing this with really tiny amounts of money. So my first few investments were a couple of thousand, and I think a lot of startups when they fundraise have a minimum check size requirement, and often they set that, in my opinion, too high. And they say, "Oh, we wouldn't take anyone for less than 50,000, let's say." And I always advise people and say it should be on a case-by-case basis. And even if someone can only put in a small amount of money, you are building a relationship with that investor. You're going to be dealing with them, hopefully, for years to come. So if you think, A, you like them, and B, they're going to bring value, and maybe they can only invest a small amount now, they might be about to do really well. Maybe they can put more into the next round. Maybe they've got a great network, which is what I was sort of pushing, and I could bring in other people. My ticket might be small, but I can open up, my books, and I can bring in a lot of bigger people. So that's maybe a whole other conversation. But I started off investing very small amounts of money, but essentially positioning myself as someone who could be really helpful. I'd been through a bunch of startups already at that point. I had good connections, whether it be to investors or advisors or people they could hire. So yeah, a lot of the early ones, I ended up just basically becoming pals with the founders and just doing it that way. And then, you build a bit of a profile as an investor, and whether it's on LinkedIn or just word of mouth, you put up a couple of angel investments, and then, more and more start coming. And I'm at a stage now where I probably get sent 10 to 20 decks a day. So it kind of snowballs a bit. Yeah.
We'll talk about decks a bit later, but I just also want to understand a bit more about from the angel's perspective. There's some really good kind of tax incentives for investing in risky businesses. Can you kind of tell me a bit more about those and how that might be useful for early stage brands to know?
Yeah, absolutely. So we do have a great scheme in the UK, and I know a few other countries in Europe. I think in particular France have been looking to copy that in recent years, but it does make what is inherently a very risky investment quite a lot more attractive. So it's called the EIS scheme, and off the top of my head, I can't even remember what that stands for, but it's something like
Enterprise Investment Scheme.
There you go. Thank you. And there's also something called SEIS. So when you first go out to fundraise for your business, you have a small pot, 250,000, that you can raise under this SEIS scheme. And to put numbers on it, if you invest £10,000 into an SEIS eligible business, you immediately get half of that amount back from HMRC. You can write that off your tax bill. So I've invested 10,000. I get a certificate back saying I can knock 5,000 off my tax bill that year. So that's nice in the short term. In the long term, if that business goes up in value and it sells for 10 times the amount that I've been, the valuation I've invested at, I don't pay a penny of capital gains. So it's capital gains exempt. And then if the business goes bust, which obviously there's a relatively high likelihood it will do given the stage of investment we're talking about, you can claim something called loss relief. So of the amount that you've actually risked, so the 50% that actually is at risk, you can claim back the percentage that you pay in income tax. If you pay 45% income tax, you can claim 45% of that initial 5,000 back. So your downside is quite heavily protected and your upside is all yours. So that's what makes it attractive. And then, I focus on SEIS. SEIS, as I say, is only for that very first 250,000 you ever raise. After that, for many years and for many more millions, you've got something called EIS, which is exactly the same. The only difference being it's 30% you get back from HMRC of your initial investment, not 50, but still attractive and still
incredibly attractive. So it can kind of reduce your investment drastically. Is there any kind of general rule that angels will only do SEIS or anything like that?
Okay, occasionally. I mean, I do know a few angels who have a strong preference for SEIS. I would say, it does seem very attractive. It is even more attractive than EIS, but at the same time, by its very nature, investing in an SEIS business means it's incredibly early stage. It hasn't even proven anything in most likelihood. So, it's nice if it's available. And I do a mixture of the two. I would advise that although SEIS looks better on paper, there's a reason it's more attractive, is because you are taking an even bigger risk. So I think do a bit of both.
Is there a rule of thumb? Because you said a lot of businesses, it's risky. A lot of businesses will fail. Is there a rule of thumb as an investor, how many of these investments you think should work?
Yeah, good question. I mean, I think, you look at the venture capital world, and this is more from the tech side of things. And, the big famous VC funds will always tell you kind of one investment will return the whole fund. So there is this mentality that you might invest in a dozen or, many, many companies, and you assume that the vast majority fail and literally one of them will be the fund returner. It's not quite the same in consumer, in the world in which I spend most of my time. And I have to say, again, this is very anecdotal. This is my experience. I've invested in quite a lot of tech businesses, and I've invested in a lot of consumer businesses. The death rate in the tech businesses is much higher. It's quite binary. You either succeed or you don't. It's a heavily competitive world. Fundraising is highly competitive. So I have had a lot of companies that I've invested in that pure tech go bust quite quickly. It's very apparent very quickly it's not going to work, and the cost of running these companies is so high. Paying software engineers, hundreds of thousands, etc. So they die quite quickly. In the consumer world, in the CPG space, the deaths haven't come nearly as far. I've had a few that have died, but I've done close to 100 consumer investments. So you would expect that. But the death rate is a lot lower. The hyper growth isn't necessarily there. Consumer brands are in most cases not going to scale like a super successful tech business can. But yeah, I mean, my general thinking is probably sort of a third when it comes to consumer. A third are going to do really well, a nice multiple. A third will be very sort of average, and I might not get a huge return on them. Who knows how that'll happen. And a third will probably, not work out within the first kind of 2 to 3 years. That's probably the general thinking. But of that top third, you're hoping a few of them end up being 10, 20, 50x your money. So that is roughly kind of how I look at things. People are probably listening thinking, God, he's got that so wrong. He's going to have a really nasty shock when 90% of them go bust. But yeah, I mean, so far I've been doing this now for, for 7 or 8 years, and possibly a bit longer. And yeah, on paper at least, a lot of them are doing pretty well. The difficult thing is getting out, and that's probably another question.
Exit, right? Okay, yeah, we will come to that. But so, as you say, since you started investing, you've backed more than 100 kind of startups, many of them in food. So presumably, you out of the third, you've seen the ones that work and the ones that don't. And what would you say you've learned that makes a food or drink business a genuinely good investment?
Good question. I mean, most of the ones that I am investing in need to obviously find their customer base, and they need to do that through retail, or they need to do that through direct channels to the consumer. I think the ones that have really worked have really struck a chord, found an audience, managed to get listings in the major supermarkets. They've managed to create some hype. And once you've got a few listings can be taken away, and it's a tough world, and the buyer might change, or the focus might change, and you might be kicked out. But once you've got a few listings with the major grocers, you're not safe, but definitely got a very strong foundation. So that is obviously a key indicator. I think with any of the startups, whether it's food or my other investments, it's usually down to the the founder. And this is a massive cliche, but it is that kind of grit and single-mindedness to get through multiple rounds of funding, multiple disappointments, trying to get these listings, trying to get whatever. So it is just, and therefore, I'm slightly turning your question, but in terms of what you're looking for in a founder, it's someone that is compelling enough that you think that person will attract investment. You think they'll be able to hire well, that build a good team around them. They're not going to scale a food business as a sort of solo founder. You might be able to do that kind of thing in more technical fields, but you're going to need a marketing team, a sales team, an operations team, etc. So, are they the kind of person that can attract and retain talent? Are they going to be able to, build a really steady business? So, it's an intangible thing, and if we knew what it was, we would get every investment right. But I've worked personally in a bunch of startups. I've obviously met and sort of interviewed and invested in hundreds, but you get a sense for who's got it and who doesn't, and who's in it for the long term, and who's probably going to give up if things get a bit tough.
Yeah, because you're judging all those things presumably before they've built the team and before they've kind of persuaded the buyers and before they've shown resilience. So that must be kind of hard to. Do you have to kind of meet them to?
Yeah, I meet as many as I can. Obviously, sometimes people are in different countries or different parts of the country, and you're stuck on Zooms or whatever. But no, I think it's important to meet. Obviously, the nice thing about investing in consumer products is you've got a product to try, and obviously, taste and appearance and packaging, etc. It's all really important. It's obviously a personal view, and you never know what the buyers and what other consumers are going to do. But at some point, if you're a consumer investor, I think you've got to back your own taste and your own judgment. And is this a good product, or are other people going to think so? Is it filling a gap? Is this going to go mainstream? But yeah, as much as possible, I try and meet them.
And from what I understand, you get, I think you said it earlier, you get five to 10 pitch decks a day, which is an insane number. Presumably, what makes one stand out. Like, what is it?
Yeah, I mean, there's a real range in quality, I would say. I really think, this shouldn't necessarily be the case, but we're in a kind of consumer brand world. Like, image is a lot. So sometimes when a founder has kind of cobbled it together themselves, even if they're great and the underlying business is great, it can let them down a bit. So I do often encourage people just to find a kind of freelance designer or someone, give them a few £100 to just tidy it up and make it look as good as possible. I'm not encouraging every early stage business to go and spend a fortune on a full blown branding agency and do all that kind of thing. But obviously, not many people receive as many as me, but most of your potential investors are going to be seeing lots of things. You've got to stand out. You've got to grab them quickly. It's like being on a supermarket shelf. You've got to catch the eye. You've got to draw them in. Yeah. So as with on a shelf, the actual deck itself needs to be attractive. It needs to have a clear messaging. Understand it very quickly. So what is the product? Why does it need to exist? Who are the competition? Why is there a gap? Why is this the team to do it? What have you done so far? How much are you looking to raise? What are you going to do with that money? And what are you going to do with that money is pretty much always the same, right? It's going to be, I'm going to hire a team, going to put it on marketing, going to buy stock. But it's important to show you've got a grip on that next stage, because bootstrapping it and spending small amounts of your own money and kind of building it slowly is quite different to when you suddenly get an injection of a large amount of other people's money and all the accountability and difficulties that come with that. And it is another level of stress. Obviously, in a way, it takes away the stress that it's not all your money that you're potentially spending. But yeah.
So you're saying you kind of want to receive like an 8-page PDF with a page on each of those kind of items, which looks great.
Yeah, absolutely. I think typically they're probably a bit longer. I mean, the average I see is probably between sort of 12 and 20. Right. So if there were more 8 pages out there, that would be good. At the same time, I don't love a teaser which leaves too many follow-up questions and is very much just too high level. So I think you have got to crunch down into a few numbers. The important things of your revenue, your forward-looking forecasts, your margin, and how that will change over time. Again, a lot of these businesses are incredibly early stage. They've ordered a very limited amount of their stock, so their pricing, their margin is terrible, and forward-looking forecasting is just a finger in the air, because they might be speaking to a Tesco's and a Sainsbury's, but until those kind of contracts come through, it's them selling to a few individual shops, or it's them selling through their own website, and they're not marketing. So often the numbers are very small at this stage, and you are kind of buying into a founder's vision a bit.
I think speaking to a lot of founders, they're often hesitant about sharing commercially sensitive information in their decks. What do you say to that?
Yeah, I usually push back on that, to be honest. And I would usually say that a lot of people are doing similar things. If you have got a competitor out there, they're probably heads down on their own thing. And are the numbers that you're doing in a particular small retailer going to make that competitor sort of put their heads up and come and copy you? I think you can get very sort of focused on your own stuff. I think and the issue is that the investors do need to see this information, otherwise they're not going to invest. And I know a lot of investors who have a blanket no policy on NDAs. So you get, and it comes across as a little bit naive potentially to say, oh no, we're not going to tell you any of our numbers until you've signed this, and until we know this, that, and the other. So I completely understand not wanting to give away sensitive information. I think it's finding a balance where you're giving the investor a full and accurate picture of the business. If there's something incredibly secretive, like there's a massive new listing coming, or they're doing a partnership with someone, and you genuinely, maybe by that third party, are not allowed to share that information, then of course that needs to be protected and have NDAs and whatever. And I've had that before, where founders have said, I've got an amazing piece of news, we've signed a deal with whoever, or we're entering this new market, but it's still being negotiated, or that they've asked us to, there's an embargo on the information because there's an exclusive press release or whatever. So in that case, of course, but I think more often than not, trying to get people to sign NDAs before you share initial information is just going to slow things down. And you do want to get those conversations moving quickly. And it's probably a good idea to share as much as is sensible.
And just in case people out there don't know, NDA is a non-disclosure agreement, which
so if you did have something sensitive, you can get that investor or that third party to sign it, and then you can share the information with them. And if they were to break that and then share that information widely, you could essentially sue them.
If you have the money.
If you have the money, and they're not particularly enforceable. I mean, you hear about them in very different contexts around celebrities behaving badly and all that kind of thing. And it's well known that they're not really, that enforceable legally. But it is just another level of kind of security, I guess.
So talking about decks, is there anything that is a big no that kind of instantly turns you off about the multiple decks that you receive every day?
Good question. I think one's, this is pretty obvious probably, but often I find some that don't contain many images. They don't contain much sort of proof of what the product is.
Right.
It's just a lot of text. It's a sort of dense kind of A4 Word doc, and that is all well and good maybe in other industries, but I think in a world in which you're pitching someone a product and something you want them to be buying. So that's the only thing. I also potentially, it's good to be optimistic, it's good to aim high, but you occasionally see people's forecasts which jump up from we're going to do 100,000 of revenue in year 1 to year 3 we're doing 100 million, and there's kind of, we admire your kind of your ambition, but sometimes people are a bit unrealistic, and you think, is the whole market for your type of product even that big? And that can look a bit naive. So I think that's a key thing. Be ambitious, but within reason, so people don't discount you as someone who's got their heads in the clouds.
Yeah, because in terms of valuations, for example, so when you raise investment, you're valuing your business at a certain amount, and you're selling shares in it based on that. And those valuations can range drastically. Have you got any kind of views on that, and how early stage founders should value their business when they're looking for investment?
Yeah, no, it's a complicated question, and it's an art, not a science. I mean, when you get to later stages of businesses are valued on very kind of clear scales. It's it's a multiple of their profit, or it's a multiple of revenue, or and it's very easily done. These are sometimes pre-revenue and definitely pre-profit businesses. So it's very much a sort of finger in the air. I would say the general way in which it's done is the kind of percentage of the business the founder is willing to give away.
Right.
And the general rule of thumb is, in your first round of funding, let's say you decide on a number. We want to raise £500,000,
Yep.
which will allow us to do X, Y, Z. And you probably want to, aim to give away 15% of your business, and it'll probably land somewhere between 15 and 20. The investors will push for a better deal. They'll try and get 20% of the business. This is not like Dragon's Den. This is not, Duncan Bannatyne offering you a very small amount of money for 40% of your business. You do not want to go and give away too much more than 20%, because there are many funding rounds to come. And, it's important for the founder to obviously retain as much of their business as they can. A good investor should also recognize that. You don't want to disincentivize the founder. So any investor out there who tries to kind of screw over a founder by taking a vast chunk of their business in the early stages is doing themselves a disservice, and it's not going to end up being a success for anyone. So it's really that range of dilution. But valuations, really differ. And sometimes it might be either they're just getting really good traction early on and they've already got really strong sales. And like anything, it's sort of FOMO. Are there other investors that want in? And then, the investors can be basically told, sorry, the valuation's this if you want in. In some scenarios, even if there is very limited commercial traction, it might be the founders have had previous successes.
Right.
We sold our last business for this, therefore we think we can justify this valuation. But I see a huge range. I see businesses with similar numbers raising money at valuations of 1 or 2 million or 5 million plus. There's really no rhyme or reason to it. As with anything in life, something is worth what someone's willing to pay you for it, basically.
Hey, I just want to pause here for a moment, because one of the biggest reasons why startups fail is because they don't manage their finances well when they get listed, whether it's cash flow, commercials, or cost of goods. I always say that right from the start, you need serious financial expertise on your team. Our sponsors, Harmonic Finance, specialize in exactly this: finding finance and accounting talent for startups and scale-ups like yours. So whether it's a permanent CFO or fractional support to get ready for scale, they understand the unique challenges of emerging brands. Check them out at harmonicfinance.com.
In terms of finding these kind of early stage startups, finding angel investors, it seems to me the whole system is slightly skewed towards people who've got kind of rich friends and family. Is that the case?
Yeah, I think so. Well, on the one hand, that is helpful. I do know I speak to a lot of founders who say, I could go to my friends and family and some of them have plenty of money or, good jobs and they could put in the money. But I'd like to at least have some external people giving those friends and family the kind of, the peace of mind that they're putting their money into something good. Raising money in the early stages is really tough. So if you've got personal access to it, you've got a good network, that is a massive help. But and quite rightly, I know a lot of founders who are a bit reticent to just go out and, and get a load of money because, think of the pressure that then puts on you. You're going to be at Christmas with these people, you're going to be at dinner parties with people, and they put in money that you may lose. So even when people
they'll be like, "Why aren't you working? Why are you enjoying Christmas?"
Exactly. Why isn't your product on the table? But I think even in a scenario where you do have good access to investors, most people want to go and find kind of third party, unknown to them investors who are, maybe sector experts, but at least they can then go to the friends and family and say, look, this guy that knows about this space is investing a large amount of money, and that should give you the credibility. So I think, having a good personal network, having wealthy friends and family is obviously a benefit, but it's not everything, and will only get you so far. I mean, even the most well-meaning friends and family are not going to continue funding a loss-making business or whatever. So you do at some point need to attract, external third-party investment as well.
So if you're looking for people you don't know, or you don't have your old boys network to fall back on, where do you find these angels?
Well, I mean, a biased answer here, but kind of that's what I do is I introduce these founders to those potential investors, and there are all sorts of angel networks out there. There are all sorts of accelerators and incubators. There are pitch programs. There are great competitions, and I know Bread and Jam do lots of these things. So there are ways of getting yourself in front of audiences. A lot of founders these days are building a really strong personal brand. Whether that's through LinkedIn or through Instagram and getting it out there. And there are some rules about what you can and can't say in terms of advertising, fundraising. It is regulated, so you can't necessarily sort of take to Instagram and start saying, send me money. But
really? You're not allowed to do that.
You're not allowed to. Well, I don't think so. I don't know the exact rules,
right.
But definitely around crowdfunding, there is quite a lot of regulation, and I think people do these days say, quite kind of loosely worded. They'll put a LinkedIn post and say the business is growing really well. We're fundraising. Get in touch if you'd like to learn more. Yeah. You can't sort of share all that much, and you have to be confident that the people you're marketing the investment to are sophisticated investors, and there are various other considerations. So yeah, but there are ways of getting in front of people. I'm not going to sugarcoat it. It is really hard. Right. There are a lot of investors out there looking for investment, and B, everyone and there are very kind of clearly advertised VC funds, and everyone's like, oh, well, this VC fund invests in food and drink, and I'll reach out to them. But invariably they will turn around and say, oh, great, well, come back to us when you're doing £1 million of revenue, or these days actually considerably higher in many cases. So the people you often have in mind as the logical investors are actually not your investors at this stage. They might be an investor a few years down the line, but you do have to go and find these mysterious angel investors, and that can be harder than it sounds. So yeah, it is important to put yourself out there. Hopefully you get a bit of momentum, and one investor introduces you to other investors, right. And whether it's formal or informal, they sort of create a syndicate and they bring in their friends, and you get there eventually. And I am part of dozens of successful funding rounds every year, but I also see founders that are unable to do that, whether they're just not that great at finding the investors, or the business itself doesn't have the kind of the forward momentum and the traction to attract that investment.
And I also kind of want to challenge the idea of investing as a thing itself, because I've seen a lot of kind of bootstrap businesses succeed as well. So that is more than possible to do it that way. Like, do you see new brands raising investment for the sake of it?
Sometimes, and I know where you're coming from, and I think it's a bit of a vanity metric to name drop the fund or say the amount you've raised. At the same time, let's credit the founders here. They wouldn't give away chunks of their baby, their business, unless they needed to. If you can bootstrap the business and it, your product, your model is very profitable and you can do that, then absolutely go as far as you can without raising external money. I also think we shouldn't kind of over-egg how helpful investors are. A lot of investors say, oh, we know this industry inside out. A lot of investors you'll never hear from again. They'll send their money, they'll become an investor, and then they'll open your investor updates. But a lot of investors promise access to their networks, access to their great experience, and you just don't hear that much from them because they're split between lots of different things. So as a founder, don't think investors will solve all your problems. They won't. So yeah, absolutely. If you can bootstrap, you should. If you can bootstrap the business to a good level of revenue and a strong business, you'll be able to then raise external money at a much higher valuation. So some people literally want to go out and fundraise off an idea, and therefore you're giving away equity very early, and you haven't got the traction to sort of justify a very high valuation. So if you can go away and do as much as you can yourself, but at the same time, we know that consumer businesses don't make money at the early stages. So if you've got tons of money to burn, then you can do this. And if you're exit your previous business or come from a successful background, you have access to that. But a lot of investors have put their life savings into getting the first products ready, and they inherently need third party investors to come in and give them the money to make that first hire, to order the first significant amount of stock. And depending what the product is, you might have to order pallet loads of it, and you might not be in a position where you can take the risk of spending tens, if not hundreds of thousands on stock that then needs to be stored in a warehouse and then needs to be shipped. So, there are really significant costs involved in these things. And external investors are not a kind of silver bullet, but they can obviously help an investor speed things up and get access to things they couldn't otherwise afford.
So what if I'm looking for a kind of angel investors other than their money? What kind of things should I be asking them? Like what other kind of added value things can I see if they'll help me with?
Yeah, I think that's exactly the right approach, in that I think a lot of founders, feel like they're being grilled and, they're being asked all the questions. But I absolutely think you want to create this sense that you're in a position to choose between lots of investors. So you should be getting the investors to say, justify why they should be getting onto your cap table and why they should be, allowed to buy part of your business. And back to that previous point, this is someone you're going to have a relationship with over hopefully years to come. So only take investment from people you like and you're going to get on with. If you really dislike being in a room with that person and you think you're going to clash, then do not let that person invest, because it's only going to get worse over time.
Right.
But I think find someone who's got helpful experience, and some will be more willing to be a mentor and a sounding board than others. As I say, some you won't hear much from in the future, but you can find someone with good experience who can be a helpful kind of advisor, then go for it. They might well, if they're from the industry, have contacts at retailers, at distributors, at 3PLs. There might be really, really sort of tangible benefits from their network or from their knowledge. So absolutely, if you can find those people are gold dust, obviously, who can say, oh, I know this other investor who should come in, or I can probably help you get into Waitrose, or I can find you a cheaper packaging supplier, or whatever it might be. So absolutely, you should ask those investors like what they're bringing to the table, and do your due diligence on them.
Right.
If they say, oh, I invested in XYZ other business, maybe give those founders a call and say, what do they like to work with? Should I take their money? Because you might find that founder says, we wish we hadn't taken them, or you might find that you're better off not. So
About 5 years ago, you started the Green List, which is like a curated platform for connecting founders and investors. Tell me more about that.
Yeah, so I mean, two things that are happening when I started my first few angel investments. One is that a lot of these family offices and funds and much kind of deeper pocketed and more sophisticated investors started reaching out to me and saying, hey, random guy, who are you? We keep seeing your name on cap tables. We come to invest in a business and you're there first. So they wanted to know what I was up to, but crucially, they wanted the deal flow. So they were kind of asking me to send them deals. And I was, an operator at Deliveroo and Weezy and all these other companies. So they also wanted to run ideas past me, with my operating hat on and get my thoughts. So I had a lot of investors asking me to receive deal flow. At the same time, when I would speak to a founder and I would say, oh, I'd love to put in this small amount of money, they would say, well, that's great. But the thing is, we're trying to raise, 400,000, 500,000, $1 million, whatever it was, your small check isn't really going to get that done. But if you could help us with introductions to the serious investors, that would be much more valuable. And I had no knowledge of this industry, but all these founders started telling me, yeah, we're working with people who are telling us they're going to do that, charging us fees and doing all sorts and not producing the goods. So I kind of, as a complete side hustle, was like, yeah, sure, I probably do know some investors who'd be good for this. I can introduce you. And I started making those connections, and it's led to tens of millions of investment into a lot of different startups. So that's how the green list started. It was something I would do on the side, and I would think, I really like this business. I'm going to put a small amount in. Let me see if I can find some other people. And it sort of grew and grew as something I would do. I was doing on the side of all my other jobs, and then ultimately it's become my full-time thing. And I always really enjoyed it because I've worked at a few really interesting startups. I've worked at a VC fund. I've had a few different roles in my time, but I really enjoy hearing about new businesses, that kind of excitement of the founders, getting to know them, and ultimately, if I can be helpful and help them raise this crucial funding, it's a pretty kind of key role to play. So it's nice to be part of those exciting early stages, and it's nice to, touch wood, be part of a positive thing of them raising money, and then I invest in all these businesses that I help raise. So I've built this massive portfolio where I now have so many fingers and so many pies, and some of them doing really well, and hopefully that continues.
What a great opportunity to kind of see all these different brands doing different things. Do you think there are kind of certain types of businesses or categories that are getting investors really excited at the moment, and any that are kind of a bit oversaturated?
Yeah, I mean, I think what's definitely an important trend at the moment is anything functional. So sort of adding protein, fiber, vitamins, adaptogens, functional mushrooms to traditional products and categories. So there's always 1,000,001 supplements coming out with, quite kind of clear cut route one, here's a gummy, here's a powder, here's whatever. But actually, if you can have a traditional product, whether it's a soft drink or it's a bar or it's a whatever, which has added fiber, added protein, added vitamins, that is a big trend. I mean, a good example is my largest investment this year has been into a drinks business called XOXO, which is a better for you soft drink. So similar to Olipop and Poppy and all these big success stories in the US, it's a delicious soft drink that's also got added fiber and is good for your gut. So if you can essentially scratch that itch, have that indulgent soft drink, that chocolate bar, that thing you're kind of really conditioned to having that, really, really satisfies. But, at the back of your mind, also feeling good about the fact that it's doing you good. It's lower calorie, lower whatever than the kind of the traditional options. And it's, got added things, and that's always good. So functional food and drink, definitely a big one. I do, but at the same time, and it's not necessarily directly at odds with this, is also what I see as a big sort of anti-processed food and drink, so anti-UPFs. And so people are looking for kind of cleaner label. So there's an interesting balance between adding positive things, but also people wanting to see nice kind of, clean labels, and not wanting to see sort of 12 syllable, isolates of this and that, and getting a bit concerned about that. So it's an interesting balance, and I'm seeing some really kind of simplistic products, really back to basics, products saying, look, we only have 3 ingredients in our product, and that kind of thing. But at the same time, going to other extremes, you've got people selling products which have the most incredible macros, huge amounts of protein, 0 calorie, all sorts of things. So they're almost competing. It'll be interesting to see which sort of wins out. I mean, both are interesting and both can perform well. There are a few trends that I think will die out, and there are a few trends that I think are overdone. I think it's interesting to see what works in the US and in other markets, and does translate here, and that what doesn't. And there are some, if you look at something like hard seltzers, huge category in the US, White Claw being part of that, dozens of others. I must have seen 20 decks for UK based hard seltzers, and the hard seltzers do particularly well in the US for all sorts of complicated reasons around how it's taxed and around all sorts of things. And White Claw in particular, but other brands have kind of built really strong, really strong kind of moats there. And then they've come here, but you have these small companies trying to do that. So that's an example of
one that hasn't worked.
One that hasn't worked. I think when you see something working in the UK, often there is a precedent in the US or in other markets, but it doesn't always work the other way around. Not everything that works in the US will work here. You do see a few things that look great, and there's evidence for the founders to get excited about, and they can come and tell you this category is worth billions in the US, so it will be here, but it doesn't always work that way.
So to wrap things up, what advice do you have for founders out there looking for their first investment?
Good question. I think, well, one thing to address is that it's very time-consuming fundraising, and the sad reality is it will take up a lot of your time. So I think you need to be in a position. You might want to even think about the time of year you're doing it, sort of seasonality things. I don't think people discuss that. It's going to take you a few months. Even in the best case scenario, you are going to be looking at this, and you've got to run your business at the same time. So maybe don't choose, the busiest time of year. Maybe don't choose whatever. At the same time, what gets funding rounds across the line is positive momentum in the business during that fundraising process. So you're going to speak to an investor multiple times, and what really gets someone to sign on the dotted line and give you their money is that from the first conversation to the next conversation, you can say, oh, in the interim, we've raised this amount of money, we've had commitments from this person, we've also just got a listing with so-and-so, our sales on Amazon are up 60%. So you also need to have a period when numbers are going to be looking quite good. If you try and fundraise in a period where, because of seasonality, because of your stock or whatever, you're about to have a few low months, then that's probably not a great time to choose. So people will be like, hang on, how come your revenue's going down? You were telling me we were this was a hockey stick up and to the right. So there are all sorts of considerations. But one thing, just sorry to go back to my original point, it is going to take up a lot of your time. So do have your ducks in a row, have your deck ready, run it past as many friends and family, make sure your messaging is really clear. Try and run everything in parallel. So a lot of people do these fundraising outreaches very piecemeal. So they'll reach out to a few people they know first, and then a few weeks later, they'll reach out to a few more. You need everyone, moving at the same pace in as much as you can, because you want to create that FOMO. And you also want to be in a position where if someone says, yes, I'm in, you can actually act on that. And you don't have to say, oh, sorry, we need to wait for a dozen other people, some of whom I've only spoken to once, some of whom I haven't even spoken to yet. So try and run it in quite a disciplined process. It's like anything in sales. You want to put a lot in the top of the funnel, and you want to try and sort of work your way through. And you have to be very persistent, very tenacious. These people have all sorts of other priorities. So they might say, oh, let's schedule in something for next month, push for no, let's do it this week. Right. I can come to you. Let me come to your house and drop off some product. Yeah. You want to get product in hands. If you can be there when they're trying it, even better. Obviously, some people aren't up for that. But if you can be there and say, let me talk you through the product. I mean, how much better does that work than someone, finding us something in the post and nibbling away on it without really remembering, what was going on. So I think that's important. Just sort of stick to your guns, be confident in your business, tell them this is going to be a great investment, and if you want them as an investor, again, back to that point, if you think this is a good match, then, like anything, get them to believe in you, and hopefully you'll get them on board.
Nick, amazing insight there. Really full of actionable, kind of tangible things. Thanks so much for your time, and best of luck with all those investments.
Thank you. Thank you very much.